Good morning, boys and girls. Welcome to the Flow Show. It's Thursday. This week seems to be dragging by really slowly. All the other weeks seem to fly by, but this one seems to be going a bit slower, maybe because I'm on my own. I don't know, a bit tired this week as well. So lots have been going on in markets to keep us busy anyway, and plenty more has happened since yesterday as well. So let's crack straight into it. Over in China, and their state council and Communist Party have said they will make precise supportive policies for the private economy. Apparently they are looking at easing some mortgage rules to spur home buying in big cities. This isn't so much related to interest rates or anything like that. They have specific rules over there where if you've held a property previously and don't do so now, you don't get classified as a first-time buyer and indulge in any benefits that come with being a first-time buyer. But they're looking at maybe reducing those rules or taking away those rules, so you do get qualified as a first-time buyer once again, giving you access to those benefits. We have heard this week also they're looking at putting in place grants and special measures for smart homes and people to upgrade their homes as well. So lots of these little things are being put in place rather than big stimulus easing as might be expected. That's proven to date also, where they left their loan prime rates unchanged. 1 year left unchanged 3.55%, 5 year left unchanged at 4.20%. Now, one thing that has got the markets on a hop, well, a couple of things really. As you can see there today, we've had a big steep drop off in $1, is that they eased their cross-border funding via what's they call a macro prudential parameter, a bit of a ratio number that they've reduced. Long story short, big multinational companies that operate in China, they are limited as to what foreign currencies they can use. So basically they have eased that to allow them to bring in more foreign money and exchange it for local currency, i.e. the yuan. It just means they can bring more money in. It's just loosening conditions for those multinationals. That's why we've seen this big drop in $1. They also continue to set the yuan very low. A lot of people have been massaging this. It got set at 7.1466, but if you think that we were up here, then we had all this news and it came down here, people are calling it the strongest fix for ages, but it's still there or thereabouts to where the move went to. If we were trading at 7.23 and they fixed it at 7.14, that's a different kettle of fish, and they probably wouldn't have been able to do that anyway, because that would have been likely, I suspect, outside the 2% band that the onshore one is allowed to move in. But anyway, they're still setting low fixes. Definitely a case of rallies being sold up here. People are a bit more anxious when they get call it dovish news out of China. I think we are firmly in rally selling mode here, so I'm going to be looking personally, if we get another move up towards these highs, I'll be looking at potentially getting into some shorts, maybe up to the 730s, but I'm not sure if we're going to get there based on the news that keeps dropping out of that. So yeah, I'm slightly more bearish now on this pair than I have been previously. They're still in easing mode, but there's a lot more news that's coming in to say that the bigger rally might be over. Anyway, that was all added to as well. So they dropped that news about the cross-border funding. Then apparently major banks were seen selling dollars in early Asia trade as well. So whether that was to do with the cross-border funding news or whether they were sent out to do a job remains to be seen. But there's, as I say, the things lining up as to why this isn't rallying anymore, or could rally significantly anymore, are growing. And I don't want to be fighting that particularly. On another front, China's imports of Russian oil for June were at 2.56 million barrels per day, which is a record for the month. So they're still happy to purchase off the Russians and give Russians all their lovely money. Part of obviously the paddy stuff that goes on with those guys. Now some big news in Japan. Whoop-de-doo, some good news for Japan. Their trade balance came in a positive 43 billion yen. For the first time in nearly 2 years, we've seen a positive trade balance. Now, before anyone does a jump for joy, there's a reason why we have to look closely at trade balance data. As you can see there, exports not as hot as expected, only coming up 1.5%. Imports down more than expected, minus 12.9%. So activity-wise, two things: you're seeing a big drop in imports and not quite a significant rise in exports. That is obviously one of the reasons why you can get a positive trade balance. It's a bit like how I was talking about oil and the deficit surplus thing yesterday. So it's not such good news, this number, even though they've turned a surplus. The reason being, for the month of June, the yen was nearly 7% weaker compared to last year. So that means that exports cost more, if you like. So that pushes the value of imports up. Okay. On the flip side, energy prices fell at a faster rate than the yen weakened. So that reduces the value of fuel imports, which has been a big part of inflation in Japan. So the value of those fuel imports has dropped, which then adds some disinflationary pressure, which is what the BOJ have been banging on about, that they saw a lot of their inflation due to energy prices. Now those are falling back. They're seeing that drop out. We've seen it in the trade data, and likely we're going to see it in the inflation data. Now back to the trade balance. Exports actually fell in volume terms, not value terms, volume terms. So it's the old scenario of potentially paying more but getting less. So these trade balance data, the TLDR version, the too long didn't read version, is that positive trade balance, but it's not as good as it seems on the surface. There is underlying factors that suggest it's not so good underneath. So just a little lesson there in how we should look at things like trade balance data and how the details are important. In terms of the BOJ, a lot of Bank of Japan watchers are now seeing Ueda and the BOJ staying put at their meeting next week, and they now see October as the tweak month, new tweak month. I'm not so sure what's going to happen next week. We saw dollar yen getting sold off in big part to what was going on in the US, the move down from 145, in big part to peak rateness happening for the US in now. Also, tweakers getting expectant for next week, and we got that until Ueda came out yesterday and stamped on that, on Tuesday, and stamped on that a bit. Well, now the government have stamped on Ueda a bit because they've cut their 2023 growth forecast to 1.3% from 1.5%, but they've hiked their inflation forecasts. Okay, for the current fiscal year, they now see inflation hitting 2.6% versus 1.7% forecast in January. That's significant because it's 6 pips above the Bank of Japan's 2% target. For 2024, they expect inflation to hit 1.9%. So that's fiscal year 2024 and fiscal year 2023. So 1.9% for fiscal year 2024, which is just a pip under the Bank of Japan's target. So what that's done this morning, I think, is it's probably solidified 140. As mentioned, Ueda put a bit of a stamp on the tweak expectations by saying that unless their assumptions of inflation changes, they won't be looking to change policy, or that policy is appropriate. The market took that as saying next week they're going to stay unchanged. As mentioned yesterday, that still leaves the door open a little bit, because they could change their assumptions at the next meeting. They're not going to tell us that in advance. But the government now hiking their inflation forecasts maybe means that the Bank of Japan will follow on next week and also raise their forecasts, which now leads us back to potentially getting closer to a tweak. They could do their forecasts, change their forecasts next week, but not do any tweaks and indicate a tweak further down the line. Either way, if they up their forecast above target, if they indicate a tweak or do a tweak, whatever one of those three scenarios, we're likely to see the end game, because it is then another step towards ending their easing. So everyone who ran from one side of the boat in this move and then on Ueda ran to the other side of the boat, now I think the boat is pretty much in the middle going into next week. So as mentioned, I think getting through 140 might be a bit of a harder task than I thought it might be yesterday. But we shall see. Price wise, it's doing what it needs to do. It's holding the support at the broken 139. Now we need to see what happens up at 140. Let the games begin, let battle commence. We need to go with one side or another. Coming over to Australia, and jobs data was pretty strong out of Australia. Employment change up 39k. Up 32.6%, 32.6k for the employment change. So it beat the 15k expected. It was another solid number for the full-time change, 39.3k, and part-time employment dropped. So if you want to see job strength in these numbers, you want to see full-time employment getting all the numbers rather than part-time. The participation rate dipped a little bit, which added to the unemployment rate coming in unchanged at 3.5%, was expected to rise a pip to 3.6%. So solid numbers still for Australia. They're on pause, but they've been saying that one of the things they're keeping an eye on is a jobs market, and it is tight and continues to be tight, as those numbers show there. Coming into Europe now, Germany's PPI, another drop in the month, down 0.3%, but year on year we're still falling back, but not seeing any negative numbers yet. Came in just a pip higher at 0.1% than expected, but down from 1% last year. So much like a lot of countries, PPI also now moving vastly lower. On the ECB, ECB's Nagel says practically everyone at the ECB expects an increase of 25 pips next week, and that the ECB are very likely to raise by 25 pips next week. One of the less hawkish, ECB Stonas, says that inflation is falling, so more tightening could hurt the economy. Next week's interest rate hike would be enough. So he's one of the doves, and he's still pumping for a hike next week, but then largely says enough is enough there. So for next week's ECB, the 25 pip hike is nailed on. All the market moves are going to be around what happens in September. Will the door get firmly shut on another hike, given the data we've seen already? Will the door remain open? Will it be more finely balanced? That's conversation to be had amongst the ECB members. That's a conversation the market will move on afterwards. So if we get to a pause next week, if there's indication of a pause next week, then I think the upside for the euro is limited from the euro aspect, irrespective of what the dollar does. So from the euro side of things, I think we may be limited in gains for the euro therein or thereafter, because much like with dollar yen and the Fed, the market saying we've peaked on rates here, so no more upside for the dollar. The same thing's going to happen to the ECB next week. The same thing will happen to the Bank of England after its meeting, so on and so forth. The same thing that has happened for the RBA. So all we're trading right now is peakness in interest rates, and the ECB will answer that question next week. So just so you know what to look for. As far as economists go, all 75 respondents polled by Reuters expect a 25 pip hike next week. So as I said, the whole market thinks it's nailed on for a hike. For September though, only 35 out of 75 predict no more hikes, so just under half, and 40, the balance, now see another 25 pip hike in September. So very finely balanced, pretty much 50-50 there on whether they hike or don't in September. Over to the Bank of England. BOE's Ramsden, not someone we hear from a lot, said he cannot rule out that next interest rate cycle for the UK will get rates back to the zero lower bound, i.e. cutting all the way back down to very low levels. Also says we need headroom for new QE, hence why they want to get rid of the balance sheet now, so they've got room to build it up again if the need arises. Latest inflation data shows that indicators of inflation persistence and is still a bit higher, and that inflation is still a bit higher than expected in May. The impact of bank rate increases is taking quite a bit longer to come through than expected. That's something that's caught off a lot of central banks who thought that they might see a faster impact from rates. Could be that it's still all building up in the shadows and waiting to be unleashed on economies, and we start to see some serious problems develop. But for now, we're all looking at soft landings or very mild recessions. Over in the US and the NBA data, mortgage rate, I was just keeping an eye on more so out of anything yesterday. Where was it? Over here. 2 weeks ago, it spiked up from 6.8% to 7.07%, potentially indicating that we may start to get some problems for refinancing and stuff in the US at higher rates, but it's pulled back now to 6.8%. Again, this is where you can see, let's get the chart up. This is where you can see the effects of the market trading peak rates now. Let's get into something short term. So there you can see it was, what was it? Yeah, 6.85, jumped up to 7.07%, and now back to 6.85. So this was the market last week saying, thinking that the Fed is maybe one and done now, hence rates have come down. The same thing's happened in the UK after the CPI report. Mortgage rates now, 2-year mortgage rates are likely to head back down because a lot of that expectation for higher rates has now washed a bit out the market. So now it's impacting mortgage rates and stuff. In the UK, not to the same level, not to a level that makes much difference right now, but if it continues going the right way, that will provide a bit of relief. Obviously in the US, it's a different situation because most mortgage rates are done over 30 years. So it's not a variable rate that can change every couple of years on a deal, something like that. But anyway, you can see the effect of market pricing for rates and its impact in the real things like mortgages. Housing starts were out as well, a little bit softer. We're expecting starts 1.48 million, came in at 1.434 million, down from a revised 1.559 million. Building permits as well, soft as well by 50k, 1.440 million. Again, another small loss over the 1.496 million previously. This had jumped up last month, so it's had a bit of a pullback, a bit of a washout. Still no real flags coming in here, in my opinion, so not seeing anything that we should be overly worried about in those numbers. On the geopolitical front, a couple of things to be aware of. Firstly, in the UK, there is 3 by-elections tonight. By-elections are where there's vacant seats up for grabs and all the major parties will be fighting for those. Sunak, PM Sunak's Conservative Party holds 3 of these seats, or held 3 of these seats. I think a couple of vacant due to MPs leaving and whatnot, like Boris Johnson's area. Obviously, because he's been suspended from Parliament, he loses his seat, so that's up for grabs. So that was a Conservative seat. The expectations are that he will lose all 3 seats. So that's the expectation. How steep a defeat might impact the pound tomorrow, depending on what the market makes of it and obviously what the press makes of it. So those elections are happening right now. The results to come probably late into the night tonight. So those of you in the UK, Europe will be waking up to the UK press full of stories on how much of a slaughtering he potentially got last night. As I say, it shouldn't be too market moving, but it just depends if the market wants to jump on it and extrapolate that to an election, which has got to be done by the end of next year. So just keep an eye on that. If you do see some wonky price action in the quid early tomorrow morning, you'll know the likely reason why. On the Ukraine front, we've had this grain deal blow up. Russia now saying that any military ships that are bound for the Ukraine via the Black Sea will be considered targets. So stepping up the rhetoric there. They're also continuing with a heavy barrage of Ukraine ports around Odessa now that this grain deal is out the way. So a bit of a offensive by Russia after this deal, obviously trying to match the counter-offensive by Ukraine. So just keep an eye on that one in case things get a little bit heated. It's always a bubbling situation while that goes on. And just seeing some headlines crossing as well, that Poland has decided to bolster its border with Belarus because of the presence of Wagner fighters. They're doing military drills over there, and Kremlin says that that decision by Poland is a cause for concern. So the Wagner mob, as I say, doing drills with Belarus right on the border of Poland. That's caused Poland to step up their defence of the border or action at the border, and the Kremlin saying that it's a cause for concern. So these little pockets of things happening in the Ukraine still, it only takes one slip over there and then we get a big risk-off headline dropping on the wires. So while the market has been sort of ignoring it in the main, we're never more than one headline away for seeing something. Yeah, exactly, Gavin. Just as I say, just seeing that crossing on the wires here as we're doing the show. You don't get more live than that, folks. Right, that's me with the headlines and anything like that. And please feel free, if you've seen anything that you feel warrants discussion, please throw it up in the chat function here on Zoom, and we can dig into it. But in the meantime, let's get stuck into some charts and see what's going on. As mentioned, dollar yen there, holding support nicely on the break, doing what it needs to do. Top side, I think, is a bit stiffer now, up towards 140. We do have a big option expiry up there today, over 3 billion going off. So we may see that having an influence if there's nothing much going on today. Certainly on the data front, there's not too much. We've got jobless claims, which, if the market's pretty quiet, can have cause a bit of a move if there's a big variation. Also, the Philly Fed manufacturing index is out as well. Again, low tier number, but if there's a big move there in this data dependent world that we're in, then perhaps we might get a move there. That all happens at 1:30 UK time, just to have a quick look there. Jobless claims, we're expecting 242, so we've been hovering around this 235, 250-ish area for a while. So unless there's a real big out there number, if we're above 260 or below 220, we're going to move on those. Philly Fed expected to come in at -10. Obviously, keep an eye on employment and prices paid. so you can judge the inflationary and jobs market pressure that any of those that come into things. But that's really it from data. We do have existing home sales as well later on, which is a lesser of the housing data numbers. And oh, here's a good old Eurozone consumer confidence. Love this number. I'll show you the chart for this number. And you can count on one hand how many times it's been positive in the last century. Oh, look, a couple of times. There you go. See? Oh, amazing, this number. Always in the negative. I don't know why they bother. Anyway, back to the charts. So that's it for dollar yen. Another position that I'm in, euro sterling. Still looking okay. We had a little mooch into my zone. Couldn't get down to the bottom of it. So for me, 86.45.50 is the bit of a do or die line for euro sterling. It's maintaining the rally, having a little refresh, a bit of a bounce back up. It was holding back above 86.70, but it's had another little mooch below. So it's a bit wishy-washy along this line here. But it is bumping its head on the underside of that fib now. We did get a little mooch to 87, nowhere near the top of that range, up at 87, 15.20. So still a bit of work to do here. And a bit like dollar yen, it's either got to go one way or another, you know, too tight a range to ping pong between these levels for a while. So we are bouncing still. So there's still a bid in the pair, so it's every chance. I think if we get a break of this, I have heard that there's some decent stops sitting up above this level now, so we could get a bit of an acceleration, maybe up to this next zone, 87, 60, 70s. That would be my target area if we did get a break of this 87.20 area. Conversely, if we get back under this 86.45, we're likely back in the box, and then we're just going to be mooching around in there for a while. So I'm still long, still happy, still got plenty of margin in it. If we break under here, I might look to tighten my stops up a bit more just to protect what I've got. If we break above 87.20, I'll probably still bring my stops up to protect for any pullbacks and just keep moving them further into profit as the price rises. But I see no reason why this trend should change yet. There's probably still a bit more washing out of BOE rate expectations to come, although we did do quite a bit yesterday. But again, ECB next week could be a decider. If they indicate one and done on the hike front, and the Bank of England are set to keep going for one or two more hikes, then we've probably got some more mileage to the upside for this one. So that's my strategy. Anyway, that's what I'm looking to do. Let's have a look at what's good old Mike saying. Let's go back to Ali. Your short cable at 129.25. Stop at 65. Take profit at 28.95. Yeah, I think you're probably okay. We had obviously this big sell-off. This bounce looks very dead cattish, if you ask me. Let's see if I can zoom in better. There we go. We did rally a bit, you know, for cable. That's a small rally. 129 is seemingly holding up a bit better than it did yesterday. That was a level that I was thinking we might find a bit of support yesterday, but that wasn't to be. We had a little carve through. Bit similar to dollar yen when it went through 138 down to 137.20s, then bounced in 138, held, then we flapped around a bit, and then we got a bit of a rally. So if you are wanting to catch knives, I know you're short, Ellie. If you are looking to catch knives, what you want to see is 129 becoming support. It will mean a higher low, which is your first indication that maybe, at least in the short term, we've done dropping. But what you'll then want to see is just nicking a higher high. It will just start to set up the potential for a bit of an upside move. But if 129 fails again, I think we're probably looking at a move down to 128.50 and the fib down here. But keep an eye on that low. If we can't get past that low, again, set up a high low, maybe, you know, 28, 80s, 70s, that will still keep the pattern of stop falling in play, and then maybe we start to have a move up again. For your trade, Ali, you know your risk. Your stop's just above that high, and you want a little nick under 128. Just have a think about that one, because yeah, you might get 5 pips under, but if you get a break of 129, it might have a bit of legs as well. So you might want to think about maybe not taking all of it off. Take a good chunk off if that's what you feel you need to do. Maybe just leave a little piece on for interest, and see if you get a bigger move lower on a break of 129. You always know my thoughts. If I'm in a winning trade, I don't want to give it up unless I really have to. Even if I just keep a little snip on for a bit of interest, just to see if it carries, if a move carries on going. I hate giving up a winning trade unless I'm forced out of it. Short on euro as well, 112.20. Yeah, I'm looking at the euro. Since last Thursday, we've had a lot of sideways action, not really doing a lot. We just might be starting a little downtrend. You know, we had the highs up here, then we've had a lower high and another lower high. The lows are all ticking lower as well. It just maybe suggests, you know, we need to do something up here. Again, I can't stop repeating it, but that's the fact of life. We've got the ECB next week. So it could be that we're just going to be wafting sideways for a bit. The price action is, as I say, starting to show a bit of a downtrend right now. I can draw some lines if you need some lines. If I can line them up. So something like that. Let's take that off, might be easier. And something like that. So you can just see we've got a bit of a change from what it was earlier this week. This is really tight stuff. You know, we're talking 20, 30 pips, 40 pip day ranges. You know, it's not big moves. You know, it's not like what we've just seen in cable. So while this pattern is something you look for when you're trying to, you know, see if you've got a top, you know, maybe continue to get a move downwards, you're really talking small pips here, 20, 30 pips, which is all right for scalping. But I wouldn't be short in here hoping for 110 or anything like that. If you were, you know, trying to short on this pattern, get down to this trend line, you know, you want to be taking vast chunks of money off the table. And again, maybe just leaving a little bit on just to see if you do get a further move. But I'm not expecting anything here. You know, one piece of data this afternoon, fully fed, jobless claims, you know, we could be back up towards the highs again, and then, you know, it's a different picture. Suddenly we're making higher highs and we're doing something like that instead of doing what we're doing now. So, you know, the pictures can change in an instant, particularly when you've got these really tight ranges. So if you're going to trade them, just treat them with the respect that they're due. You're not going to get in hundreds of pips out of trades like that. Let me get the noughts and crosses pitch off my charts now. I hope you're all clear with that one. So yeah, for me, the 112 is loosening up a bit. It's becoming a bit on off. You know, we've had a couple of tests, a little poke there, a break yesterday, a little poke here. Unless you really start seeing this below and significantly holding below, you know, more time given. You know, even when we had this break yesterday, it lasted, you know, an hour, and then boom, we're back above again, or a couple of hours and we're back above again. That's not a decent amount of time below a level to say that it's breaking. So you want to see some good solid moves there, holding underneath it, then maybe you're going to get a steeper push down. I think this one's going to play what's called the 20 pip game, which is something this pair likes to do when it's quiet, i.e. it finds support around the 20s. So we found support near that 80 level. We're probably going to find support there again today, then the 60, then the 40, then the 20. You get the picture. When it's quiet, this thing tends to find support and resistance in 20 pip clips. So just keep an eye on that if you're trading that one. You're short, you got a decent stop. Yeah, good luck with your trade, Ali. Let's have a look. Mike, isn't it positive for the UK in the medium term to expect a lower top rate from the BOE, soft landing, better growth, stronger GBP. Yes, obviously, if we're not going to take rates up to the 6s, which I didn't think they would do anyway, you've got two things as we explain often. You've got the expectation for rates and what rates actually do. The expectation for rates is what has been causing pain for mortgage rates. It's not the fact that rates have gone that high, it's the fact that the market, if it's expecting rates to get that high, banks are going to go, well, we're not going to charge people 5% mortgage rates. If we think rates are going up to 6%, we're going to charge them 7%. So you're tightening financial conditions, you're creating pain that isn't necessarily there or isn't necessarily going to turn up later. It's all about firms and banks and businesses covering their asses on where rates may go. So we already had a bit of pain because of these expectations of rates going up, pushing up mortgage rates, potentially artificially, where perhaps they may not need to get that high. So if people locked in 3 days ago at a high rate for 2 years, they're now going to be paying a high rate, and in a couple of weeks, those 2-year mortgage rates may be 6.5% now because of the expectations dropped out. So it's creating a bit of a problem for the UK. You don't want to be locked in at 7% when you could have got 6.5 2 days later. But that's how things work. As far as soft landings go, I don't know. I think there's a bit of a risk for the UK in these rate hikes catching up and showing a bit harder than they are everywhere else. But then if the data goes the right way, if inflation starts going the right way, there will be a bit of relief, and then maybe we can think that the landing might be a bit softer than indicated. Of course, we all watch the data. That's all we can do thereafter. In regards to it becoming stronger for the pound, well, you have to throw it in the basket of how everyone else is doing. You know, the economy soft landing in the UK is obviously a good thing, but is it as big a soft landing as the US? If it's not, then obviously the pound isn't going to gain versus the dollar. The dollar's going to gain. So it's not just it's not a linear correlation. If it's good news in the UK, the pound's going to gain over everyone else. It all depends on how everyone else is doing. But where you can trade it is you can trade it off against different currencies. That's what the crosses are there for. So if the Eurozone suffers more than the UK, then obviously that's going to see Euro sterling heading lower. That's where you'll get your pound strength. If the US is stronger, you're not going to get your pound strength in cable. So pick your poison, and that's the game we're going to be playing for the rest of the year and probably into the next year. You know, as I said, who's got the cleanest shirt? That's going to be the currency that comes out on top, and that's the way to play it. Let's see, anyone else? Oh yeah, your question yesterday, Ali. If you take a trade, if it goes some pips, you save some money and then let it ride. All right, so you're looking at the ratio. Letting trade ride. So your risk reward ratio, and we've spoken about this before, it's something you should keep an eye on, but you shouldn't be beholden to. It shouldn't determine your trade. I'm happy to risk 10 to make 5 if in that particular instance I feel that's the good trade to make. You know, that's a crap risk reward, but if I feel, well, you know, I'll make a pip if I can make a pip. Doesn't matter to me. If I can make money, I'll make money, which way I can do it. So your risk reward is something you need to look at. You don't want to be trading with low risk reward, but you know, you have to take it into judgment when you're managing a trade. So if you're going to, let's take this. If you're going to buy at 112 in euro dollar, okay, what's your risk? Your risk might be below this low. Let's say we're doing short-term scalping or whatever. So your risk is you're not going to put your stop bang on that low. You're going to put it 5 pips under. So you're going to put it 1170. So you're going to risk 30 pips perhaps buying it at 112. Okay, so what's your reward? And your reward is where the trade can get to before it may run into trouble. So in this instance, and I'll just come in closer. So where's our nearest resistance? Our nearest resistance is up at 27.30. Okay, let's call it 27. Okay, so you're risking 30 here, and what the minimum you might make, or the maximum, sorry, you might make is if we don't get through here. So maybe you get out at 25. So you're risking 30 to potentially make 25. Okay, it doesn't matter if you think it's going to 80. You need to trade by what the price action is doing. At the moment, the price action says you're not getting through 28. Okay, so if you trade here at 112, maybe the very most you might get is 25 pips, give or take spreads. Okay, so you're having a stop at 70, you're risking 30 to make 25. It's not a good risk reward ratio. Okay, now how you can adjust that when you're running a trade, what you can do is you're risking your 30 to make 25. When you get your 25, you take half off the table. Okay, so now you've taken some profit, you've put it in the bank. Okay, you can, if you bring your other half up 10 pips, so now your risk is 20. Okay, so you've made 25 on half and you're risking 20 on the other half. Well, now you've got a better risk reward. You've instantly changed the tables. Okay, now you're risking 20 on the other half to make for 25 on the other half. Okay, so potentially, as I say, you've turned the tables on your risk reward. Now maybe you've got some freedom to let it go, because what you have done is you've locked in that profit. Okay, you've locked in your profit. You were risking 30, now you're only risking 20 on the other half, and you've made 25. So any which way, you're going to walk away with 5 pips on half the trade. Okay, it's not as much as 5 pips on the full trade or 25 pips on the full trade, but as with trading, the exercise is not to lose money. So I'd rather, you know, try playing the trade, managing the trade, and only make 5 pips on half the trade, because I'm trying to have a go at making more money. But as long as I don't end up losing, I'll take that all day long. And even if I did scratch it, even if I did lose it and give the other half back and ended up flat, if my worst scenario is flat on every trade I do, I'm happy with that. I'll take that all day long. So yeah, it's all about, when you're managing trades, you can improve your risk reward as you go along, depending on how you manage it. But yeah, you know, trading 112 for 25 pips, risking 30, it sounds like crap risk reward, but you've got your defined levels. You know, okay, you lose 30 pips, so what? You know, you're not going to, you know, it's not going to be 10% of your account. Shouldn't be 10% of your account. Shouldn't even be 0.5% of your account on a trade like that. So it's not going to kill you if you do lose the 30. But yeah, you can improve your risk reward as you manage a trade as you go along. Gordon says cutting your losses short will increase your average winning trade. So your full risk is not an accurate representation of your risk reward. Yeah, that's correct. But you know, risk reward either way. You don't. The first thing you should be doing with a trade is getting your risk to zero. Forget profit, get your risk to zero. Quicker you do that, you're not going to lose money if you do that. Your trade may not work, but if your risk is at zero in every trade, the most you're ever going to pay out is whatever commissions, if you pay commissions to your broker. You know, and you're not going to bust your account paying commissions unless you're over trading, of course, making zero on trades. So always risk first. Get your risk to zero. Everything after that is potentially profit. Good. I'm glad you got that point, Ali. Keep them coming. If you've got any other questions, then let us know. Yeah, Brian, you know about that from the chat room. You work on getting your risk to zero. You know, I still think you get your risk to zero too quickly. You don't really give your trades enough room to breathe. But I know you're working on that, and you've had some runners where you've got in the money, bought your stop, and then allowed the trade to run a bit further rather than just jumping out at the first opportunity. So I know you've worked on that a lot, Bran, and it's slowly, it's happening, mate. Don't worry, I'm always watching. I'm always keeping an eye on what you're doing. Good old Brown, he's been with us a long time, and he was the archetypal noob when he first joined us here. There's a book on rookie mistakes. He made every one of them, and over the years he's learned to knock out the mistakes, get over the fear, learn to read the markets, and he's by no means the finished article, but he's come a long way, still has a long way to go, and I'll let him know that as well. So yeah, keep going, Brian. Keep going, Brian. Thank you, Sue. That's what we try to do on the show, give you a bit of education as well as waffling on about the markets. Right, let's get in a few more charts before my voice goes again. So Aussie dollar got that bit of a lift on the jobs data. Obviously, it might have been a bit in there to do with the the China support measures coming in. If they're going to spark a bit of life into markets, then that's going to be good for the Aussie as well. But it's not a correlation, you know, if you're going to stick a proper trade on. I was watching this over the fix yesterday because we had a little bit of a sell-off into the fix, and I thought if we get a move to 67.40, I might try and catch the knife with just a little small trade, because you can see it's been an on-off support and resistance area. As is typical of late, it pulled up short of the level. Likely that's where buyers off this level have parked the bus just as a bit of protection off this level. Again, that's another little lesson I can give you. When you get strong levels like this that are support and resistance, when you get a break, those that bought here or bought down here and took it through this level will then what I call park the bus. So they'll stick some bids in ahead of the level to protect it, because likely they've got all their stops below it. So they don't want the price to come back down. So they're happy to step in and stick a few bids in, or just buy some up, see if they can, you know, halt the down move. But they'll do that ahead of the level rather than bang on it, because that'll be too close for comfort. So that's why in these times you get a break and it doesn't quite come back as far as the level. And then the buyers come in, they say, no, we're keeping this supportive, and then boom, you get a bounce up. So I was dangling my rod in there when I should have been dangling it probably in there. Anyway, such is life. So we've had a little bounce up, puts us back above 68. So again, look at this as a bit of an on-off level, 68. If we come down and find support there again, and as you can see, we found support around 06, 05. After the break back up, then potentially we're moving higher. Got another intermediate level, 68.50. So that's your ceiling to look at for now, anywhere above there, and then we're looking back up towards the zone and the highs at 69. If we do get a quick move back up to the 69, that might suggest that we're potentially going to have a little break of it. You know, this has been setting up for potentially a decent double top, but it's going to need that to hold below 68.50. If we do that, then maybe we continue back down a bit further. It keeps this resistance area solid up at the 69s. But if we speed on up, you know, over the next session or two, back up to this area here, it might indicate that a break might be coming. I might be tempted with a buy stop, maybe up through 69, 10, 15, something like that if it breaks. But I want to know the reason why we're up there and breaking. Looking at some of the other pairs, CAD not doing an awful lot, though it is still looking a bit weak after we had these moves up to the 134s. Bounces not looking overly hot. 132, we mooched above a bit, came back below, holding below now. Potentially sets us up for another move down towards these lows. As mentioned, parking the bus, my level was 130.80. We couldn't get through, you know, 130.90s. So that looks to be the protection there. That means if you do break the 90s, if that's where the buyers are sitting ahead of this level, then it may mean that we go through it. So I'll be less convinced to try trading here as opposed to trading just above it if I want to catch the knife in that one. If we do get a breakdown in this one, there's a bit of a gap. pretty much down to the fib here in this old trend line, or trend line since last year, which comes in at today's money around 130.20ish. 130 will obviously be a big enough number in itself. We've got a 50 fib down there as well, so down in the low 130s is where our next support area, should we break this 131, 130.90, 130.80 area. As mentioned, top side 132s, then coming up 132 to this old fib, 132.20s, needs a move back above that one. Just have a look around some of the other bits and bobs. We're having a look at Euro NOK, which is getting down to the fib. Oh, it's nearly tapped it. Look at that. My old head and shoulders worked nearly. It's on its way. I think the actual measured move is probably about there, maybe. I don't know. I'll let you aficionados work that one out as to where the proper measured move is. But we are nudging down to this fib area. So potentially looking at maybe doing something with the trend. Fibs are my marker for what happens with a trend. So this will be a test. It's a bit of a level on its own, as you can see there. Let's zoom in a bit. Maybe come in a bit shorter term. Let's have a look at the old 4-hourly. Ooh. So as you can see, it was a bit of a level on the way up. So when you get a bit of confluence there, that it's a natural level and a fib level, you've got to have a close look at it. And we're very close at the moment, 150 odd pips away, which is not a lot in this pair. But this is one euro pair going that way, whereas we've seen euro yen going the other way. So a bit of a breakdown in between what's happening in some of the euro pairs. So it's not a clear picture. Euro yen, again, we're not quite getting back up to these highs, but we've had a decent bounce, bounced off the fib, down at 153 and a half. Does what it needs to do, and then so it's setting us up a bit of range between these levels. Again, might be something to look at for a break play. Something you can run over the Bank of Japan next week. Obviously, the CPI data tomorrow in Japan is going to be the big number, or it's tonight, 12:30 in the morning for us. If it's a solid number, or sorry, if it's a weak number, and we can't get above this high here, that tells you that it's being pretty solid. Conversely, if it is a strong number and we get a move down, you want to be a bit careful this time, because we could get a big change around again in tweak expectations, which causes this low to break. But if it doesn't, you know, maybe setting up for a decent range to play. And that, again, something to look out for Euro NOK. If the ECB isn't hawkish, but we can't get through this level here, again, that might give you a bit of conviction to try longs. That's if we're still around it going into it. Some of the other pairs, those of you who like a bit of MEX, I'm still keeping an eye on this one, even though I'm absolutely screwing over it after mucking my trade up last week or the week before. Really keeps going, finding a little bit of support now. I've got a big level down at 1636. We're not even getting close to that. But in the short term, we're just doing a bit of what we did here, where we had a steep drop. Sorry, let me come out a bit more. So we had this move, and then it went sideways for a bit undecided, got a little pop before breakdown. We're getting a similar type of pattern, just on a more shorter time frame. We've had this move down here, but we're now finding a bit of a bottom. Again, just a slightly higher low suggests that something's different down here now. We're not getting through this 16, 69, 70 area for now, although the bounces aren't exactly strong. If we start taking out 1690s, then perhaps something has changed, but still tight. But talking about catching knives, this is the sort of price action you want to see, where it actually just stops falling. It's always a good start when a price is moving, when it stops moving in that direction. Looking at some of the others, gold still having a bit of a mooch up, still keeping its bid. Had a little attack of the 1986, had a little poke through, can't quite get through, not a break that can hold anyway. So as I expected, it's a bit of a grind, this one. It's not looking like it wants to take off. It's not looking like it wants to drop back after failures. So this one, if you're going to be trading it, keep your trades small, keep them tight, watch the price action. You know the levels, you're going to be wrong. Back under 1960, your big level underneath is still 1930s. Up here, you get a break here, might have a bit of legs up to the 2000, but you want it to break and hold. You don't want it just to start wishy-washing around the line on that one. We did look at silver yesterday as well, again on a bit of a grind. It's now trying to hold above 25, where it couldn't do that yesterday. It couldn't get above all the early part of this week. Now we had a little move above, but it couldn't hold it. Now we are just about seeing a hold of the 25, so it gives it a bit of a base to move on. So if you weren't long and wanted to be long, that's where you can potentially try it into 25.05. You don't need a huge trade on it. A stop maybe below 24.90.84, somewhere like that, because if you're back below 25, you're likely wrong, but you want to give it a little bit of room. And then if we're going to hold this 25.05, that's your springboard for a move up. But again, I'm not expecting rockets here, more of a grind. How the old stock is doing. Well, we had that again. It's just looking a bit grindy. I think that's the natural state of things at the moment. Not quite getting up to the 45.92s, 93s, which is my next level, but we're not pulling back significantly either. The dips are very shallow, and that keeps the trend in play. But the longer we go without a refresh, the steeper the refresh might be if we do pull back. You know, a move that's like a bit like this, where you have a strong up move, you don't see any decent pullbacks, then you get a half decent pullback, refreshes the trend, and off it goes again. So we're seeing, you know, quite a steep jump here, although it's not in pip wise, but in picture wise it looks steep. So, you know, there's every reason why if you do get a pullback, it's going to pull back maybe to, you know, 45.16, 45 before it continues higher. So just keep an eye. If we can't break through prior highs, goes a bit sideways, that maybe means a bit like here, where you're going to set up for a bit of a pullback, where you're just not getting through an area for a period of time. Then that's when you see a pullback. Then you pick your downside levels to catch a knife, or try and catch a knife, because if it is just a trend pullback, then that's where you're going to find support, and then off we go again, and likely we break those highs. Right, that's me. You've had me waffling on for nearly an hour again, so I'm going to call it a day there. Thank you, as always, for giving us your support and coming to the Flow Show. Please don't forget to give us a like on Twitter and the socials, and a thumbs up and a retweet, and spread the word. You know, the more people we can get in here, the bigger the community, the more we can talk about stuff, and the more ideas we can share. Good luck for the rest of the day. Watch out for your risk events, UK elections, Japan CPI, bombs, whatever's going on in the world. Stay safe. Peace to you all. We'll see you tomorrow. Thanks, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.